FTX stories are everywhere nowadays. They blew up in spectacular fashion this week. The FTX collapse, which saw it lose over $2 billion in value of FTT token, wiping out approximately $100 billion from the crypto market cap, has no doubt landed a big blow to the crypto industry. Isn't crypto supposed to be recession-proof and something that isn't affected by the economy? Yet here we are. Everyone is saying cryptocurrency investing was supposed to be a hedge against inflation, but lack of regulated understanding has pushed many exchanges offshore, thus allowing these exchanges to operate in the gray area. Palihapitiya, CEO and founder of venture capital company Social Capital, talked about FTX and Bankman-Fried's red flags in an episode of the All In podcast hosted by him, Jason Calacanis, David Sachs, and David Friedberg. Chamath Palihapitiya said Sam Bankman-Fried once pitched him and he had a Zoom with Sam, but after the Zoom, he was like, "This doesn't make sense, but I'll have my team do some work." We did some work and we sent him a 2-page deck. We said, here are our recommendations for FTX to take the next step. One was the formation of a board, the second was the creation of dual-class stock, the third was some reps and warranties around affiliated transactions and related party transactions. And the person that worked here called us back. "I'm not kidding you, he literally said go f*** yourself," Palihapitiya said. The response after Chamath Palihapitiya suggested changes like forming a board, FTX told him to get lost. Investors put in $2.1 billion without even a board. There's a systemic issue at hand that needs to be dealt with immediately. Chamath also said that the head of compliance at FTX was also the head of compliance at a poker site that in the 2010s did something similar to this entire FTX debacle that's unfolding. He said there was an article that appeared that said that the head of compliance at FTX was also the head of compliance at a poker bet called the Ultimate Bet, which in the 2010s apparently did the exact same version of this thing where they went in and looked at whole cards of poker players, and then a few employees inside the business would basically play against these folks, knowing what the whole cards were. Ran these cheat, stole millions of dollars, and somehow that person found a way to be head of compliance in FTX 10 years later. FTX's corporate governance has come under intense scrutiny in the last week for its small and insulated circle of decision makers, and the company notably doesn't have a board of directors. There are reports that FTX may have used customers' deposits to fund bets at Bankman-Fried's hedge fund Alameda Research. FTX commingled customers' funds with hedge funds, which is a violation of U.S. securities law. Coinbase CEO Brian Armstrong, a guest on the same episode of the podcast, said, "We're shocked that somebody like Sam, who seemed smart and capable, ended up in this real situation where it appears he has done something unethical and illegal. It appears as though FTX never really has a board. Sam was lying, he knew Alameda was not solvent." Brian said he wouldn't be surprised if the FTX US section of the company had no idea what was going on. FTX had Alameda, and it appears they might have been underwater due to the horrific events that have occurred recently. It would have potentially blown up, so Sam took customer funds from FTX since Sam owns both Alameda and FTX. He took a loan from FTX to Alameda with users' funds to bail out companies like Voyager and BlockFi. Brian thinks that maybe Sam thought he could trade his way out of this. Investing customers' assets without their explicit knowledge is illegal. Since FTX isn't regulated like a bank, they can't take users' funds and go invest it, and even banks that are regulated are not allowed to do so. Regulated companies need to ensure when they take client coins, tokens, or money, they're required to keep it 1-to-1 in their holdings. If you have one Bitcoin that you deposit, then they should have one Bitcoin in their exchange. To avoid recession after the FTX, Binance CEO CZ took to Twitter to say that crypto is not going away. "We're still here, let's rebuild." In a statement made via a tweet, he said, "To reduce further cascading negative effects of FTX, Binance is forming an industry recovery fund to help projects who are otherwise strong but in a liquidity phase. More details to come soon. In the meantime, please contact Binance Lab if you think you qualify." The CEO called for new but stable rules and regulations for the industry, noting that new players in the industry are cutting corners without following due processes. In his word, CZ said, "We're in a new industry. we've seen in the past week things go crazy in the industry. We do need some regulations, we do need to do this properly, we do need to do this in a stable way. The Binance CEO also stated that other industry players with cash are welcome to co-invest in the project to mitigate the liquidity of cryptocurrencies in the market. There were an enormous number of venture firms that talked their way into just completely doing zero work here. Here's what I mean. Chamath explained that there are lots of venture firms in Silicon Valley in this period of not doing any work. The game that they played was that they would get a team and create a token. They would also buy equity at some crazy valuation. The equity was locked up, but the tokens were not, and then they would put them on an exchange and sell them to unsuspected investors, and they would be able to dump these tokens. And if you look inside this trend, what you're going to see are the sale of securities, except it was done in a completely unregulated way. One move by a whale or a group causes instant FOMO in and or out and giant fluctuations. Pump and dumps are a daily occurrence, and no regulation makes it the Wild West of trading. A lot of time, there's no rhyme or reason to it, and trades are based on either a social media post by some a-hole or inaccurate speculations. Crypto in its current form is almost more centralized and riskier since it's also less regulated. Investors are calling for stable rules and regulations for the industry. Regulated banks are backed by the FDIC up to $250,000 per account. As we saw during the 2008 to 2009 meltdown, if a bank has a liquidity crisis, the FDIC shuts it down and merges it with a solid bank, and it opens the next day or two as a stable institution. Of course, if the original bank was underwater, more debts than asset, the FDIC has to use some of the insurance pool it controls to pump money into the new institution, and discuss how and why so many of these coins are just absolute garbage securities with zero valuation. Are a lot more people going to lose their money before their government finally steps in to regulate them out of business? The government saved the banks during the 2008 to 9 recessions. Binance and its peers should march to the Securities and Exchange Commission or SEC and say, please regulate the cryptocurrency industry, we need help. As recession fears mount on Wall Street and inflation remains well above the Fed's 2% target, some of the top commentators in markets, business, and economics have been sounding off on just how bad they think the next downturn might be. Market volatility is at an all-time high. It's precisely at times like these that investors need to be on guard against the next certainty. You don't have to act on every forecast. Success isn't created by accident, but by design. Investment is that tiny line that separates the rich from the poor. So many people are afraid of recession and inflation, but if you truly believe what crypto stands for, then you should be bullish for crypto, at least in the long run. Investors are asking, how do we protect ourselves from possibly losing assets on these crypto exchanges? The general consensus seems to be to not hold assets on the exchanges themselves, but instead hold them in a hot or cold wallet. The problem with FTX is just that people don't understand that centralized entities are the problem. Blockchain was created with the whole idea of not trusting others and instead verifying, but here we are seeing how people get destroyed by trusting an entity. A recession, no matter how bad it can be, can provide good buying opportunities in the markets if you're careful, and it can also create volatility, giving great short-time buy and sell opportunities as well. This isn't exactly financial advice, but do get to buying, as cash isn't king at all at this time.